Thank you.
Okay.
Why is it not wanting to go full screen? All right, well then what we'll do, okay. Okay, so this chapter is about bonds, as you already know. And just, I want to recap what a bond is. So a bond is an asset that comes about when we loan, I'm sorry, a bond is a liability that comes about when we borrow money from other people. And what makes it different from other liabilities, like a note payable, is that bonds, we typically borrow money from a group of investors. And so what we do when we want to do a bond issue is we go to what's called a bond agent, which is a company that specializes in creating bonds. We tell them how much money we want to borrow, and then they create a bond. They call it a bond issue, um, which will be issued at a certain interest rate, um, for a certain amount of time and a certain amount of face value. The face value is the amount that we're borrowing. The interest rate is the amount of interest we have to pay, um, and then the term, or the life of the bond, is how long we'll be borrowing the money for and how long we have to repay the bond. Um, so those three pieces of information, um, the interest rate, the face value, and the term or the life of the bond, or the maturity date, sometimes it's called, of the bond, those are going to be very important to us as we start to try to figure out how to enter these into our books as accountants. A couple of other issues that come up is sometimes bonds, um, but we don't borrow all of the money all at once. So we might not issue all of the bonds in a bond issue all at the same time. Um, if you think about it, a lot of times when you're doing, say, a big building project and you're borrowing money from a bond to pay for that building project, you don't need all of the money all at once. You might need half of the money up front, and then more money throughout the building project, um, as the building project progresses. So you wouldn't want to pay interest on all of that money um, if you don't need all of that money all at one time. Some of these projects can take multiple years. So there's another couple issues we need to know, and one is, what is the market interest rate? So there's the interest rate of the bond, how much we have to pay, but there's also the market interest rate, how much lenders are willing to lend money at any given time. That will fluctuate up and down, and that will impact what's called the uh, the the price of our bond. So there's all of these factors that go into play, and I just want to, that's kind of a preamble as we go into issuing bonds and all of the entries that go along with it. So this first example is issuing a bond at face value. What we mean when we say face value is we mean that we're going to sell the bonds for exactly the amount we're borrowing. So if we have $100,000 bonds, and we're issuing them at this price, 100, that means we're issuing them at 100% of their face value. So it means we're borrowing $100,000 and we're going to pay back exactly $100,000. So our entry will look like this. Pretty simple. Our cash will go up by $100,000 and our bonds payable liability account will go up or be credited $100,000. Now this bond, it looks like it pays interest every year. And so the way bonds work is you pay interest on set interest dates, usually either once per year or twice per year, but you don't pay back the principal or the face value of the bond until the bond's maturity date. So this bond, we're going to have to accrue our interest expense at the end of the year. And then on January 1st of the next year, we'll actually pay the interest. So to figure out how much interest we owe, we take the face value, $100,000, times the interest rate, 10%, times time, which in this case is 12 over 12 or 1, because it's one whole year. And that will tell us the amount of interest expense is $10,000. And because we're not paying it until January 1st of the next year, we will credit it to interest payable. Then on January 1st, 2018, we'll debit the interest payable and we'll pay out the cash. So we have to do this so that we recognize the interest expense during 2017, even though we don't actually pay the interest until January 1st, 2018. So when you're doing these bond transactions, you have to be careful to see what dates you're dealing with to know if we have to do an accrual entry for the end of the year or if we're just entering a payment in the middle of the year or something like that. Okay, so as I said before, interest rates can fluctuate. The market interest rate fluctuates. All we mean by the market interest rate is the amount that lenders are willing to lend at and borrowers are willing to borrow at. That goes up and down depending on just how available cash is, things like that. So we have to know that when the market interest rate fluctuates down, then the bonds are going to sell at what's called a premium. Well, the reason for this is if I have a bond that pays 10% and the market interest rates fluctuate down to 8%, my bonds are more attractive. They're paying a better rate to investors than what any new bonds being issued at the market interest rate are. So they'll sell at a price higher than the face value. That's what it means to sell at a premium. If market interest rates fluctuate up, now all the new bonds being issued are coming out at 12%, but mine only pays 10%. So investors aren't going to want to pay full price, meaning we'll have to issue these at a discount or a price less than the face value. If all of this seems confusing, at least try to remember that there's an inverse relationship or an opposite relationship between market interest rates and bond prices. So if the market interest rates go down, bond prices go up. If market interest rate goes up, bond prices go down. So here's what it looks like when we issue a bond at a discount. The example says, assume that on January 1st, 2017, Candlestick Inc. sells $100,000 5-year 10% bonds at 98. 98 means 98% of the face value. And the interest is the same as that last one, so it pays on January 1st. So what we would do is, first of all, we have to figure out how much cash we're actually going to get if we're selling this bond at 98% of face value. So we would take the face value of $100,000, multiply it by 0.98, and that would give us $98,000. So our cash will go up by $98,000. Our discount on bond payable will be $2,000, and our bonds payable will be $100,000. What this means is we're getting $98,000 in cash from this bond issue, but we're going to have to pay back $100,000 at maturity. And we're going to pay our interest on the basis of the face value of $100,000. So the difference between the amount we get when we borrow the money and the amount we're going to have to pay back, that's called the discount on the bond payable. This is what it will look like on our balance sheet. It'll show bonds payable less the discount on bonds payable. Recognize that because discount on bonds payable is related or linked to our bonds payable account, and it has a normal balance on the debit side, even though we're dealing with a liability. Discount on bonds payable is what's called a contra liability account. Okay, so the opposite of that is when we issue bonds at a premium. So in this example, Candlestick Inc. bonds are selling at 102. So again, the face value that they described earlier was a face value of 100,000. So we would take 100,000 times 1.02, or 102%, and that would be the amount of cash we're getting in this case. Let's see. So our cash will go up by 102,000. Our bonds payable will go up by 100,000. In this case, we're getting 102,000 in cash, but we only have to pay back 100,000 at maturity. And then the difference would be the premium on the bonds payable. This is meaning we were able to sell the bonds for more than their face value. And this is what it would look like on our balance sheet. We would show the bonds payable of 100,000, and then the premium would add to it. Okay, so because when we issue bonds at something other than their face value, either a discount or a premium, because we have this discount or premium to deal with, we have to amortize that, meaning we have to spread that discount or premium out over the bond's life. And we have to recognize that if I issue bonds at a discount, meaning in this case that I got $98,000 in cash, but I have to pay back $100,000, that extra $2,000 in discount is going to actually increase my cost of borrowing the money. So now not only do I have to pay interest, but I also have to pay back $2,000 more than I borrowed. So we're going to amortize the bond discount. What we're going to do is we're going to spread that discount out over the bond's life and claim it as an expense. So usually whenever we make our entries to pay for the interest, we're also going to recognize the bond discount or premium. So here's what it will look like. So if we have a $2,000 discount on a 5-year bond, we take $2,000, divide it by 5 years, and the amount of discount that we will amortize every year when we pay interest is $400. And so our interest expense will be $10,000. That's the regular interest on the bond, which we found by multiplying the principal times the rate times time, plus the $400 of discount that we're amortizing. So that'll be our interest expense. And then our discount on bonds payable will be 400, and our interest payable will be 10,000. This chart shows how our unamortized discount of $2,000 will be fully amortized over the life of the bond. And at the bonds, at the end of its useful life, when we're going to pay it off, or I would say at the end of its life, we'll have no more discount because we will have claimed it all as an expense over the bond's life. So all we're really doing when we amortize is we're taking that discount, dividing it by the number of years, and then taking it as an expense each year until by the end of the bond's life, we've fully taken the discount as an expense. When we have a premium, we still have to do something with that. We still amortize it, but it's not adding to our expense. In this case, we're getting $102,000 in cash, but we only have to pay back $100,000. So that $2,000 is actually reducing the amount of expense or cost that we have to borrow the money. So we do the same thing. We take the $2,000, divide it by the bond's life, in this case 5 years, which gives us 400, and we will amortize that premium each year like this. So we'll debit interest expense and then debit the premium, and then we'll credit interest payable. And so by doing that, what we're doing is we're saying of the $10,000 in interest I have to pay, 9,600 of it's an expense and 400 of it is an amortization of the premium, or that additional money I received at issuance for the bond. Again, this shows how we'll fully amortize that premium over the bond's life, and how the premium actually reduces the amount of interest expense. We still have to pay 10,000, but only 9,600 is going to be expense. The other 400 each year will be the premium. Okay, so that was a lot and kind of confusing stuff. I'll let you know that when I was studying for my license, this was the hardest section for me because I'd never dealt with it. So it was just totally abstract. And I get it now, but only because I've been working with it for years and years, not because it's easy. So any questions that to try to help clarify that, since neither of you interrupted me along the way, because you're very polite.
Okay. My first question is for the bonds interest. They will pay in the January in the beginning of the year. Every year the bonds interest pay cash.
Yes. So sometimes they pay twice a year. It's pretty common to pay every 6 months. So it just depends on the bond. You'd actually, if you were interested in investing in a bond, meaning you would be loaning money to a bond issuer, you would have to read the terms of that bond when it would pay interest. But it's pretty common once a year or twice a year, depending on the bond. And this one, because it pays on the first of the year, we have to make an entry at the end of the year to recognize all of that bond interest expense, and then at the beginning of the year we have to actually show the payment of cash.
Oh, that means for the end of the year we have to do the adjust entry for the interest part. Then in the January, if they pay the cash in.
Right.
Like you say, if the twice a year or 6 months, so will be the different situation. Right? If the twice a year.
Right.
Okay.
Or you know, let's say the bond paid once a year, but it paid its interest on December 31st. Then we wouldn't have to do the adjusting entry. We could just do the entry on December 31st to show the interest expense and the cash being paid. But because it doesn't pay till January 1st, we have to do the adjusting entry on December 31st to show interest expense and interest payable. Then on January 1st, we have to do the payment entry, which would reduce the interest expense and reduce cash. So that's the hardest part. That's why back in chapter 4, when I'm like, these adjusting entries never go away, they're still here to haunt us. You know, having to recognize, do I have to accrue the interest so I can show the expense for this year, even though I don't pay the interest until next year? That's why they're different.
Okay. My second question is how can the people want to buy the premium price? Because if before the maturity, they retire no. Before maturity, people buy the bond at the premium. What's the reason people want to buy the premium?
Sure. No,
most
so
people want to buy the discount, right?
Right. Yeah. So when you're a broker and you're trying to sell bonds to people, you have to really only more advanced investors would understand why they would buy a premium bond. So what you're really going for is an effective interest rate, right? So if I can buy a bond at a premium, and so I know that um, I'm going to give $102,000, but I'm only going to get back $100,000, but it pays a higher interest rate than what the market interest rate is, so that my effective interest rate ends up being better even with the $2,000 premium. That would be the only reason I would consider buying a bond at a premium. So let's say that if the market was paying 4%, which it's not paying right now, but if it were paying 4%, and I could get a 6% bond at a premium price of 101, so I would invest $101,000. I would get 6% interest on the 100,000 every year for the next 5 years, and then at the end of the bond's life, I would only get 100,000 back. That might still pay me better interest overall than if I bought one at a discount, but it was only paying 3.5%. And so you have to, as a broker, people always, they just look at that premium and they're like, no way, I don't want that. And you have to try to show them, look at why this is better, because you're going to be getting, this much total interest over its life. Really what an investor wants to do is say, how much interest am I getting in total over the bond's life? And and even account for that premium or discount, and whichever one pays them the best overall return, we call that effective interest rate, is the best investment. Did that help, or
Okay.
was that too much talking?
Um. I have a question here is because for the stock market,
Hmm.
if the bonds interest adjusts higher,
Hmm.
so the stock market will going down.
Um,
That
it's not.
it is the like you say is the maybe the broker or something, so they will impact to the money gain there. Uh, Sorry, it's another this in the cross the question, but
Hmm.
I come relate to my question. I just that the premium price maybe like you said maybe for the interest maybe right now I buy higher interest, and then the market interest is lower, but I own more higher interest, so I can get to say the premium price.
Um, yeah, I mean, remember that the borrower. So the borrower is the issuer of the bond. Okay, that's the
Uh-huh.
person that's borrowing. They kind of are at the mercy of market interest rates. They can't usually get a price that's way off from that. So even if we created a bond issue years ago, and it has a better interest than the market rate, well, we're still going to have to account for that, and would do that by, as the market rate's gone down, the bond prices are going to go up. We're going to issue those bonds at a premium, because remember, the borrower doesn't want to pay any more interest than they have to. So if market rates have gone down, then by issuing their bond at a premium, they're actually going to be paying less interest. If So the lender, or I mean the borrower, the lender, the buyer of the bond, they don't want to pay or get any less interest than they want to get the most interest they can. And so if market interest rates have fluctuated up, they're going to demand that the seller sell those at a discount. And so really what's happening is the market always sort of brings things to equilibrium, right? I mean, if you've taken economics, the market is that sort of price that buyers and sellers are willing to exchange at. And so that's what happens with bond prices, is the market just, as market interest fluctuates, the bond prices fluctuate with them. As far as relation to the stock market, it's fairly limited, except that if the stock, if interest rates are really low, like they've been for the last 20 years, really, um, then people don't really want to put their money into low interest bonds. They'd rather take their chances and take some risk and go into the stock market. I think if interest rates went up to 6 or 8% or something like that, you'd see people pulling money out of the market, which would cause a decline in the market, right? If people were pulling out en masse, to put money into those equities. Back in the early 80s, interest rates were, you could get a government bond with at like 16%. You could get corporate bonds at 20%. And so, like, why would people invest in the market if they could get something
Yeah.
like a very safe? Bonds are typically considered safer if you're buying the bonds of safe entities, right? Like the federal government or um, anyway. So I don't mean to try to give a big conversation on what drives market and bond rates. I'm not an expert in that area. I know enough to be dangerous in that area, but not enough to be helpful. Anyway, I hope, I don't know if I answered your question or if I just gave you way too much information there, Michelle. Sorry.
No, no, thank you. It helped. Thank you.
Hadney, any questions?
No, I mean, I think Michelle made the right made the right questions.
Okay.
Thank you.
All right. Well, I mean, I hope that was helpful, or at least a good use of 40 minutes or so. Hadney, I think we'll probably have to schedule another time.
Oh no, it's fine.
Okay.
It's okay.
So I have my grandkids over here, and I got to tell you, Hadney, with little ones, I don't know how old your kids are, Michelle, but it's pretty, I'm not used to it. I'm a grandpa now, and so I mostly have my time to myself. So when I've got a 4-year-old and a 2-year-old, I'm just chasing behind them, trying to help clean up, and never catching up, and feeling like kind of a failure. And I'm like, this feels like back when my kids were little. The house is all messy and I can't keep up with them, and I have to, and they're willing to help clean up, but I have to like make them, right, instead of just, anyway. So
Yeah,
my hat's
yeah,
off
that's
to
how
you.
I felt today.
Because my youngest kids right now are 15 and 17. My only 2 at home, and my other 6 kids have moved out. And so, but having grandkids over, reminds me of the exhaustion. I go to bed tired at night. But they do say, and my 2-year-old, she just follows me and says, "Grandpa, what you doing? What you doing?" And you say, "I'm setting up my computer." Why? Because I have a class. Why? Because I'm a teacher. Why? Uh, and so she says, "What you doing? Why?" And I need help, pretty much all day. So,
Yeah,
but they're pretty
yeah,
wonderful too. So I'll
they
take
are.
that.
They are. It's
Yeah.
hard but wonderful.
Teenagers aren't this much fun, by the way.
Oh
No,
man.
teenager is not fun. My son, he's 12, and my
Uh,
daughter, she's 8. Teenager is not fun. I just had a long conversation with my son last night, so it's not easy.
but as they start turning into adults, and our prayers change, and we're praying for how we can be parents to adult children, there's some wonderful things and some very frustrating things too, because you watch them doing things, you're like, that's gonna catch up to you, and that's gonna hurt you, kid. But you just, sometimes they have to make that choice and learn the hard way when they get older.
Yeah, yeah, yeah,
But a
right.
12-year-old, you still have a fair amount of control in their life. Middle school, you start to lose some. By high school, and then they're driving, and then you just hope they're good people, because they'll make some bad choices, even good kids.
Yeah, parenting is not easy.
Yeah.
I admit that it's not easy.
All right.
Yeah.
Well, thank you so much. If there's no other questions, we can go ahead and end the meeting. And always, never be afraid to reach out if you need help with anything.
Sorry, I still have one more question.
Oh, I thought
Uh,
I'm sorry.
for the bonds types, they have the secure, unsecure. For the unsecure is no exit. To secure.
Hmm.
How can the people buy the bonds but they don't have the asset?
Sure. So all that means is so if I issue an unsecured bond, what it means is I'm not pledging any assets to back that bond up. You're just lending money to me on on the basis of you believe I'll pay it back to you. So typically, unsecured bonds have to pay a higher interest rate, higher than market, and so people are willing to sort of take their chances. So let's say, for example, you had one company that was issuing a secured bond that was secured by a building that they were building, and it was paying 4%. And another company was issuing an unsecured bond that was paying 7%. A lot of people would say, I'm willing to take the risk to get the higher interest, because even if a secured bond, let's say the business goes bankrupt, there's still going to be this lengthy period of legal lawsuits, all of the creditors of this company saying, we demand our money first, and the bondholders having to hire a lawyer saying, but ours was a secured bond. And so after all of that gets settled, then they would sell that asset and they would divide that up among the bondholders. And so you probably wouldn't get face value out of it anyway. But that's a rare thing. Anyway, so the short answer is that typically unsecured bonds pay higher interest, and that's why people will invest in them.
Okay, just people if they want to take the risk. So it's okay.
They'll take a higher risk.
Yeah, higher risk. Okay,
it's kind of like credit card debt is unsecured debt, right? Like if you use your credit card, the bank is lending you money just only on your promise to repay, as opposed to your mortgage, where you're pledging the asset of your house as collateral for that loan. And so that's why a mortgage is 4.5% and a credit card is 12 to 20%, depending on your credit score.
Okay, thank you.
Okay, well, everybody have a great day. Hadn't they email me? I responded to your email. Just email me and we'll set up a time.
Yes, thank you.
All right, have a great day.
All right, bye. Thank you.
Bye.
Bye-bye.